Most people believe that building wealth through investing requires extraordinary intelligence, perfect timing, or access to information that nobody else has. They imagine successful investors constantly discovering hidden opportunities before everyone else notices them. They picture complicated strategies, endless research, and flawless decisions that somehow guarantee financial success. The reality is much simpler. The habit that builds wealth year after year is not finding the perfect investment. It is investing consistently regardless of what the market is doing. This habit sounds almost too simple to matter. Because of that, many people underestimate its power. When someone receives a paycheck, they usually think about expenses first. Rent must be paid. Bills need attention. Groceries are necessary. There may be entertainment, travel, new technology, or other purchases waiting for the remaining money. If anything is left, perhaps some will be invested. Smart investors reverse this order. They decide in advance that a portion of every paycheck belongs to their future. Only after making that investment do they decide how to spend what remains. At first, this difference appears insignificant. After all, investing a few $100s every month hardly seems capable of creating enormous wealth. But investing is not about what happens during 1 month. It is about what happens over thousands of days. Consistency transforms ordinary contributions into extraordinary results. Imagine two people earning exactly the same income. One waits for the perfect moment before investing. The other invests every month regardless of market conditions. The first investor spends years watching economic news. They wait for better prices. They wait for more certainty. They wait until markets feel safe. The second investor simply continues making regular investments. Years later, the difference between them often has very little to do with intelligence. It has everything to do with consistency. Markets rise, markets fall. Economic conditions improve. Economic conditions worsen. Yet disciplined investors continue following the same habit. Why? Because they understand something many people discover only after years of experience. Time in the market usually matters more than timing the market. Every month invested allows compounding to begin working. Compounding is one of the most remarkable principles in finance. At first it appears almost invisible. Returns are small. Growth feels slow. Progress seems ordinary. Many people become impatient during this stage. They assume investing is not working. Some stop completely. Others begin chasing riskier opportunities. Unfortunately, these reactions interrupt a very process capable of producing substantial wealth. Compounding needs patience. It needs consistency. Most importantly, it needs time. Each investment creates the opportunity for future growth. That growth then begins generating additional growth. Eventually, returns begin earning returns. The longer this process continues uninterrupted, the more powerful it becomes. This is why experienced investors become less concerned with short-term market movements. They understand that temporary declines do not erase long-term opportunities. In fact, market declines often allow disciplined investors to purchase quality investments at lower prices. While others become fearful, consistent investors quietly continue building ownership. Another reason this simple habit works so well is because it removes emotion from investing. Human emotions often become the greatest obstacle to financial success. When markets rise rapidly, people become greedy. They feel pressure to invest larger amounts. They chase trends. They believe prices will continue rising forever. When markets decline, the opposite happens. Fear replaces confidence. People hesitate. They postpone investments. Some sell precisely when prices have already fallen significantly. Both reactions damage long-term performance. Consistency eliminates much of this emotional decision-making. Instead of asking whether today feels like a good time to invest, disciplined investors simply follow their established habit. The decision has already been made. Every month they invest. No debate. No emotional struggle. No attempt to predict tomorrow. Over many years, this approach often outperforms more complicated strategies because it removes one of the greatest risks in investing: inconsistent behavior. The financial markets reward participation. They reward patience. They reward discipline. The simple investing habit that builds wealth year after year is not exciting enough to appear in dramatic headlines. It does not promise overnight riches. It rarely creates sensational stories. Instead, it quietly produces something much more valuable: financial independence built one consistent decision at a time. There is another reason this simple investing habit is so powerful. It changes the way you think about money itself. Most people see money as something that exists to be spent. As soon as income arrives, attention immediately turns toward purchases. There is always something new to buy, something to upgrade, or another expense waiting to be paid. Money comes in, and before long it disappears again. Investors develop a different perspective. They begin seeing every dollar as a worker capable of generating additional workers. Instead of asking, "What can this money buy today?" they ask, "What can this money become 10 or 20 years from now?" This single question changes almost every financial decision. A small investment may not appear impressive today, but an experienced investor understands that today's contribution is only the beginning. Given enough time, even modest amounts can grow into something far larger than most people imagine. This understanding creates patience. Patience creates consistency. Consistency creates wealth. Another advantage of investing regularly is that it reduces the pressure of trying to predict markets. Many beginners spend enormous amounts of time searching for the perfect entry point. They study charts, follow financial news, and wait for signs that now is finally the right moment. Unfortunately, the perfect moment is usually visible only in hindsight. Markets are unpredictable. Unexpected events occur constantly. Even professional investors struggle to forecast short-term movements consistently. Rather than attempting to predict every change, disciplined investors accept uncertainty as part of the process. They continue investing through good markets and bad markets. They understand that some purchases will occur at higher prices and others at lower prices. Over long periods, these differences become less important than simply remaining invested. This approach also develops emotional resilience. When markets decline, regular investors are less likely to panic because market declines have already been included in their plan. Instead of viewing lower prices as disasters, they recognize them as normal parts of investing. Every downturn eventually becomes another chapter in a much longer story. History repeatedly demonstrates that markets experience periods of fear, recession, recovery, and expansion. The investors who remain committed through these cycles often benefit the most from future growth. One of the greatest misconceptions about wealth is that it requires extraordinary opportunities. In reality, wealth is more often the result of extraordinary consistency. Making one excellent investment is helpful. Making hundreds of disciplined investments over decades is transformative. This is why successful investors rarely become distracted by daily headlines. They know that long-term wealth is not built in a single day, a single month, or even a single year. It is built through thousands of ordinary decisions, repeated without interruption. The habit itself becomes more valuable than any individual investment. Eventually, something remarkable happens. Your investments begin contributing more growth than your own deposits. Your money starts working harder than you do. The portfolio develops momentum. Compounding accelerates. The process that once appeared slow begins producing increasingly meaningful results. Many people call this luck. Experienced investors recognize it as the natural consequence of patience and consistency. The greatest investment habit is not predicting the future. It is continuing to invest regardless of uncertainty. Markets will always fluctuate. Economic conditions will always change. News headlines will always create reasons to worry. But disciplined investors understand that uncertainty has always existed, and successful investing has always required looking beyond today's emotions toward tomorrow's possibilities. Year after year, decade after decade, this simple habit continues producing results, not because it is exciting, not because it is complicated, but because it aligns perfectly with the timeless principles of compounding, patience, discipline, and long-term thinking. In the end, the greatest fortunes are often built not by those who make the most spectacular decisions, but by those who quietly repeat the right decision over and over again, until time transforms ordinary investments into extraordinary wealth.